half. Let's get into the sector right now. Scott Siefers is a managing director and senior research analyst for Piper Sandler. Scott, great to have you with us.
Hey, Melissa, thanks. Good to be here.
How are you thinking about regional banks, the bounce that we have seen in the past couple of days, and what the environment is? Because it's hard to think about the valuation of a regional bank if you don't know what the operating environment will be, particularly in terms of regulation going forward.
All good questions. So we think this is going to be a pretty volatile group for some time. So I'm very hopeful that the sort of panic behavior in selling that we experienced on Friday and Monday is coming to a close. In that vein, it sort of makes sense that we got that bounce yesterday. I'm very hopeful that there will be follow through, just as something that would engender a little confidence in the group. But the reality is we've had a very serious shock to the system over the last few days. While some of the risks were kind of hiding in plain sight, they also seem to kind of come out of nowhere, which seems a little counterintuitive, but that's the reality. So the kinds of things that we went through the last couple of days, unfortunately, they exposed a pretty serious blind spot in the market's confidence in the system. So, even if the panic is over, which again, I hope it will, now we sort of start the heavy lifting of how do we ensure that something like this doesn't happen again. That's going to take a few forms. It'll take a long time to actually affect. As you appropriately noted, there's probably going to be some pretty enhanced regulation down the chain. But I think we're sort of beginning the aftermath. So you could almost say this is the end of the beginning, so to speak.
When you take a look at your sector, and I know you don't cover SVB in particular. But prior to this, did you look at available for sale, held to maturity, and what the mark-to-market losses could be on this?
Of course. In fact, that's been when I made that comment about these issues kind of hiding in plain sight. That's exactly what I was referring to. For the better part of the year, or part of a year since the Fed started to raise rates, we've all kind of known that there were these unrealized losses lurking within the space. So I think, there are literally hundreds of billions of dollars of these within the industry as a whole. So they've hit tangible equity, which is a gap measure. But except for the largest banks in the industry, a la, say, JP Morgan, B of A, Citi, Wells Fargo, the bulk of the industry is allowed to remove these unrealized losses from calculations of their regulatory capital. And we also said, with the benefit of the hindsight, I think we all looked at this in probably the wrong way. But these are money good securities. They're generally treasuries, mortgage backs, things like that. But unfortunately, when you rip rates higher the way we have over the last year, the value goes down. And we always sort of chuckled insofar as those weren't really serious to the narrative unless they were forced to be sold. And unfortunately, we got a really catastrophic situation last week with Silicon Valley in so far as evidently they were forced to be sold to meet depositor withdrawal demand. So something that we knew became very serious very quickly. $620 billion in unrealized mark-to-market losses in both available for sale as well as held to maturity assets, according to the FDIC chairman. That's as of the year-end 2022. So I don't know what those marks would be currently. Have you gone back to reevaluate your ratings on banks, given what we've learned in the past week or so? Excellent question. Well, these issues are all kind of moving at light speed, right? So it's nearly possible to keep up with them in real time. But so we do our best. I'd say as I look at the industry, there are a couple of kind of clear places to hide. The universal banks, broadly speaking, they're subject already to much more stringent regulation, and by that I mean capital requirements, liquidity requirements, what we would call living wills. In other words, a bank's sort of means of dissolving itself if it came into a real crisis. So I think investors are going to continue to hide there, and depositors will probably continue to hide there as well. So our favorite name in that space is JP Morgan, which strikes us as a very clear beneficiary of all this. You'll probably see quite a bit of deposits and ideally customer relationships moving their way, just because the market has determined that these sort of colloquially too big to fail names are going to be the safest havens here. Beyond the kind of money center banks, if you look in the regional space, we're looking for good risk profiles. We're looking for strong capital profiles. And in that vein, I'd point you to a name like a Fifth Third, a Citizens Financial. Those are good solid names in our view. But in the regional space, we're really
beginning to kind of isolate that group as the area where regulators are most likely to kind of pinpoint enhanced supervision. So that, again, that'll be a long process, but that's sort of where things seem to be flushing out.